In 1999, 1 gigabyte of RAM cost over $2,000. Today, less than $4. That 500x price drop isn't just a fun fact for your tech history buff friends. It's the hidden force behind every single AI breakthrough you're seeing in 2026. Forget fancy algorithms or bigger datasets for a second. The real story is simpler. AI models are getting exponentially cheaper to run, not just because chips are faster, but because the memory they need is becoming nearly free. This isn't just about your phone. It's about the economic engine powering OpenAI, Google DeepMind, Anthropic, and every startup trying to build the next big thing in AI. We're about to dive deep into the billion-dollar memory market, the unsung hero of the AI revolution. I'll show you why historical price trends aren't just predicting the future of AI, they're literally creating it. And more importantly, what this means for you, whether you're building AI, investing in it, or just trying to understand where the world is headed. Let's get into it. There's a hidden force driving every AI breakthrough, a silent partner in every ChatGPT query and every Stable Diffusion image. It's the humble memory chip, and right now, it's undergoing a revolution. In 2023, the global memory market, specifically DRAM and NAND flash, hit an astonishing $92 billion. But here's the kicker. Intel's CEO Pat Gelsinger recently said that by 2030, the semiconductor industry could hit a mind-boggling $1 trillion, with memory playing a starring role. We're talking about a multi-hundred-billion-dollar market segment that very few people are actually talking about. Think about this. The average iPhone 15 Pro Max comes with 8 gigabytes of RAM. But for an AI server, training a large language model like GPT-4, you're looking at hundreds of terabytes of high-bandwidth memory, or HBM, a specialized, incredibly expensive type of memory. That's a scale difference of 100,000 times. This isn't just about making faster computers. This is about the very economics of artificial intelligence itself. The cost, speed, and availability of memory chips are the limiting factors for every major AI player, from NVIDIA to Microsoft. And right now, we're seeing a fascinating, almost predictable historical pattern playing out in chip prices that could tell us exactly where AI is headed in 2026. This pattern isn't new. We've seen it before in the early days of personal computing, the rise of smartphones, and even the dot-com bubble. Understanding these cycles isn't just interesting. It's crucial for anyone trying to navigate the next wave of AI. So, let's dive into the history of memory cycles and what they can tell us about the future of AI. The global high-bandwidth memory, or HBM, market exploded from under $500 million in 2022 to over $2 billion in 2023. This isn't just growth. It's a tsunami, projected to surge past $12 billion by 2026. The driver? Large language models and the insatiable demand for AI. See, conventional memory like DDR5 just can't keep up with the data requirements of modern AI models. Imagine trying to drink from a fire hose through a coffee stirrer. HBM, on the other hand, is built for parallel processing, offering over 1 terabyte per second of bandwidth in its latest iteration, HBM3E. This incredible speed is why you find HBM at the heart of NVIDIA's AI accelerators, like the H100 and the upcoming B200 and Blackwell platforms. It's what allows these chips to crunch through petabytes of data for training and inference in high-performance computing and data centers. While other memory types like GDDR and LPDR have their places, HBM's unique stacked die architecture, where multiple memory dies are stacked vertically and placed incredibly close to the GPU, minimizes latency and maximizes throughput in a way that's simply indispensable for complex AI workloads. This shift is so profound that HBM is projected to account for 30% of total DRAM market revenue by 2026, a massive leap from just 8% in 2023. This isn't just about faster chips. It's a monumental transformation of the entire memory landscape. But all this power comes at a cost, leading us to the price of power. HBM's profit paradox. The premium pricing for high-bandwidth memory is staggering. It's currently 5 to 10 times more expensive per gigabyte than standard DDR5 memory. This dramatic cost difference isn't slowing down, either. Analysts project HBM prices to jump another 50 to 100% in 2024. That means for every AI server built, the memory subsystem can easily become the most expensive component, significantly dictating the overall system cost for enterprises and cloud providers. Why the astronomical price tag? It boils down to manufacturing complexity. HBM isn't just flat memory chips. It's a marvel of engineering, requiring 3D stacking of multiple DRAM layers, interconnected by through silicon vias, then integrated onto a base logic die. This complex process often uses advanced packaging techniques like TSMC's CoWoS, chip-on-wafer-on-substrate, which itself adds significant cost and lead time. Factor in stringent testing to ensure high yields for such intricate structures, and you start to understand the expense. For HBM manufacturers like SK Hynix, Samsung, and Micron, this translates to significant profit margins. SK Hynix, for instance, has invested billions into HBM production, and they're reaping the rewards. When you look at an NVIDIA H100 GPU, which integrates multiple stacks of HBM3, a substantial portion of its sky-high price, often exceeding $30,000, is directly attributable to the embedded HBM. This premium cascades down, making AI infrastructure incredibly expensive for anyone building large-scale models. The real challenge, then, isn't just the price, but getting your hands on it in the first place. The severe supply constraints in the high-bandwidth memory market are creating a critical bottleneck for the entire AI industry. Right now, only 3 players, SK Hynix, Samsung, and Micron, possess the specialized expertise and sophisticated manufacturing capabilities to produce HBM at scale. This isn't a simple component. The manufacturing process is incredibly complex, heavily reliant on advanced packaging technologies like TSMC's CoWoS or chip-on-wafer-on-substrate. And here's the kicker. TSMC's CoWoS capacity itself is extremely limited and comes with notoriously long lead times. Adding to the scarcity are the consistently low manufacturing yields for HBM chips. A substantial portion of produced chips simply doesn't meet the stringent quality standards required for AI applications, meaning fewer usable chips from every wafer. To put numbers on it, while HBM capacity is projected to grow from 100 to 120 million gigabytes in 2023 to around 360 million gigabytes in 2024, and potentially 700 million gigabytes by 2025, even this aggressive expansion struggles to keep pace with the exploding demand from AI. This has created intense strategic implications. AI companies like NVIDIA, AMD, and Intel are locked in a high-stakes battle for this limited HBM supply. We're seeing situations where companies are forced to make significant upfront payments or commit to multi-year contracts just to secure their allocation, reminiscent of the early days of the personal computer when component shortages dictated market leaders. This scarcity isn't just a bump in the road. It's a foundational challenge that echoes historical tech battles in fascinating ways. We've seen this movie before multiple times. During the dot-com bubble of the late 1990s and early 2000s, an insatiable demand for internet infrastructure led to massive overinvestment in fiber optics and server farms. Companies like WorldCom expanded aggressively, often beyond immediate needs, resulting in a glut of capacity when the bubble burst. This period, from 1999 to 2001, saw hundreds of billions in capital poured into infrastructure that then sat largely unused, devastating many smaller players. This echoes the infamous boom and bust cycles in the DRAM market, which, since the 1980s, has been characterized by periods of high demand driving up prices, leading to massive capital expenditure on new fabs, followed by oversupply and plummeting prices. Remember the DRAM winter of 2018 to 2019, where prices fell by over 80%. That wiped out billions in market cap and forced consolidation. The current rush to secure HBM feels like that all over again, a true gold rush mentality. Everyone wants to be the early mover. Right now, the AI infrastructure build-out is mirroring the early internet's server farm expansion. Investment is rapid, often speculative, in core components like networking gear and, crucially, high-performance memory. Analysts at Tech Insights are already flagging that while HBM demand is robust for the next year or two, the rapid capacity expansion planned by SK Hynix, Samsung, and Micron for 2025 and 2026 raises questions. Can AI adoption sustain this growth? Or are we heading towards another oversupply situation if more efficient memory solutions emerge or the pace of AI development slows? This historical context is crucial for understanding what happens when supply catches up to demand. The question for 2026 isn't just about demand, but about the industry's ability to manage that eventual equilibrium. By 2026, the HBM market is projected to skyrocket past $12 billion in revenue, capturing a staggering 30% of the total DRAM market. This isn't just growth, it's a fundamental reshaping of the memory landscape, solidifying HBM's role as the muscle behind high-performance computing. The biggest technological leap we'll see is the transition from HBM3 and HBM3E, which are prevalent now with chips like NVIDIA's B200, to the next generation, HBM4. This isn't just about incremental improvements. HBM4 promises to push memory bandwidth to unprecedented levels, but it will also introduce new manufacturing complexities, potentially exacerbating the current supply constraints. Think of it like the jump from PCIe 4.0 to 5.0, a massive performance boost, but with significant engineering hurdles. The strategic chess match among the top three players will intensify. Micron, for instance, has recently entered mass production of its HBM3E for NVIDIA's B200, a critical win that establishes its position in the top tier. Samsung is aggressively expanding its advanced packaging capabilities, recognizing that the interconnects and stacking are as crucial as the memory itself. SK Hynix, meanwhile, is expected to continue its leadership in core HBM development, maintaining its first-mover advantage. But this continued high demand and limited supply mean elevated HBM prices are here to stay, keeping the cost of cutting-edge AI hardware out of reach for many smaller players. This creates a fascinating dynamic. A two-tier AI ecosystem could emerge, where only the largest corporations and well-funded startups can afford the most powerful infrastructure. However, we can't rule out disruptive technologies. Solutions like Compute Express Link, or CXL, are gaining traction. CXL allows CPUs and accelerators to share memory coherently, potentially creating a new class of memory architecture that could challenge the HBM oligopoly or at least alter the demand curve for specific workloads. It's too early to call it a direct competitor, but it's a wild card to watch as the industry evolves. So, what does all of this tell us about the future of AI in 2026? It's clear that while the insatiable demand for HBM is propelling the industry forward, we're navigating a market defined by high costs and a concentrated supply chain. This isn't merely a technical challenge. It's a strategic one that will dictate which AI ventures thrive and which falter. The question isn't just if capacity will catch up, but when and what the pricing landscape will look like once that happens. Will this current boom sustain its intensity, or are we heading towards a classic tech cycle correction as the market recalibrates? This historical context suggests that even the most revolutionary technologies aren't immune to market forces, and understanding these patterns is crucial for any operator looking to build in this space. Given what we've seen with past tech booms and busts, how are you personally hedging against potential supply shocks or price corrections in your own projects or investments related to AI infrastructure? I'd love to hear your insights in the comments below. If dissecting these underlying economic and supply chain dynamics of new tech is valuable to you, consider subscribing. I regularly break down how these big shifts impact real businesses and investors. And if you're looking to understand more about the practical implications of AI, my recent analysis on how open-source LLMs are challenging the dominance of proprietary models is exactly the next thing you should watch.